Who's that happy looking guy right there? No, not that guy. This guy. His name is Stephen Mirren, and he isn't just another economics PhD at the Fed. He was just appointed by the president to a vacant seat as a governor in the Federal Reserve. This is a guy who comes straight from Trump's White House, where just as recent as last week, he was the chairman of the White House Council of Economic Advisors. His appointment creates a lot of concern for people, and the fact that this could erode the Fed's independence. We've always relied on the Fed to be an apolitical force, but with the former White House insider on the board, it's fair to question if their decisions will truly be insulated from the administration's agendas. The Federal Reserve's apolitical position is a topic that came up after the last FOMC meeting, where Jerome Powell held rates steady, which was no surprise, but he dropped a little gem in his press conference. Powell basically hinted that the Fed might have cut rates already if it hadn't been for the White House's tariff tantrum. That comment alone showed that the Fed is actively factoring in political decisions, and Jerome Powell has stated that he and the committee are data dependent, which makes them more reactionary instead of proactive. But at this moment, it sounded like he was being proactive to White House and congressional policies, which flies in the face of the separation between monetary and fiscal policy and an apolitical Federal Reserve. But with that, does the Fed actually have a reason to start cutting rates in the September meeting? Recent labor data has painted a complex picture of the American economy. While the unemployment rate has remained relatively stable, fluctuating between 4 and 4.2% throughout the year, a closer look reveals some underlying concerns. The labor force participation rate has been shrinking, or in other words, the number of people available to work is decreasing, and a growing number of people are not actively seeking employment. This suggests a cooling job market and a call to action by the Federal Reserve. However, several factors may help further explain what's going on. To affect the number of immigrant workers in the country and is beginning to reduce the number of new workers entering the country by either H-1B visa or through other means. Major employers, including the federal government, have been offering severance packages to employees. These packages often come with a clause that prohibits the former employee from filing for unemployment benefits, meaning they don't show up in the labor market data. Is beginning to have a noticeable impact, particularly on the labor market for recent college graduates. The unemployment rate for this demographic is currently above 7%, a stark indicator that AI is starting to automate tasks and roles that were once a common starting point for new graduates. This trend has led some analysts, such as Adam Taggart of Thoughtful Money and Darius Dell of 42 Macro, to suggest that the future of the American economy could be lowercase I-shaped. This I-shaped model suggests a society with a widening gap between a shrinking group of extremely wealthy individuals and a growing, less affluent working class. This potential outcome would be the result of a failure to adapt fiscal and monetary policies to the changing AI landscape. But the Fed is projecting a cut in September. According to the latest data from the CME FedWatch tool, there is now a greater than 85% chance that the Federal Reserve will cut the federal funds rate by at least 25 basis points or 0.25% at their next meeting, bringing it down to the new target of 4%. This potential cut is expected to be the first in a series of cuts, with current projections giving a 45% chance that the federal funds rate will end the year at 3.5%. A drop in the federal funds rate would have several significant impacts on the market. Lower interest rates typically lead to higher bond market values, and lower interest rates on major loans such as credit cards, autos, and homes. Looking at this chart, we could project that the line would drop down to around where the belly of the curve is at, around where the 2-year and 3-year bond rates are at right now. The remainder of the curve, the 5-year through the 30-year bond rate, could remain where they are, but that end is more influenced by inflation rate projections than it is the Federal Reserve. As the federal funds rate decreases, high yield savings accounts and money market funds will also decrease their interest rate payments. Some major banks with large deposits are already cutting their overnight rates to decrease the amount of interest they're paying out to clients and customers. Some people would consider turning to gold and other commodities to make up for the loss in interest and hedge against inflation. However, a recent announcement by the White House suggests they might enact a tariff on gold bars. Gold bar imports were at issue earlier this year when the Atlanta Fed said the U.S. experienced a drop in GDP, partly due to an increase in gold bar imports. It might pay to wait and see how this announcement affects the price of gold in the near future. For now, the classic plays are still some of the best plays. Stock market ETFs that reflect the best companies in America, such as VOO, OEF, and QQQ, are performing well this year, regaining all of their losses from the April fiasco and pushing well into positive territory for the year. And then there's Bitcoin. Maybe not.